right now we're in the middle of earnings season. And I mean, we've got, Meta earnings, I think, just came out and it's down 8-9% right now. And the earnings just really I mean, David Ryan would call them gold mines and landmines. You're either up 20% or you're down 20%. It sometimes seems like there's very little in between. How do you go about handling earnings season, especially with your short-term trades?
Yeah. Well, so overnight is where you have the big earnings risk, of course, right? You hold the stock, it reports after the close or before the open. Netflix just got whacked too, so they're starting to hit some of the stocks. Now, here's the thing you have to remember, with stocks like Nvidia, Netflix, Amazon, if you look at the institutional sponsorship, institutional ownership, you're talking about 5,000, 7,000, 8,000 funds that own these. What that doesn't mean that the move is over, and it doesn't mean that it can't go higher. But what it does mean is there is a lot of ownership. There's a lot of potential supply. So when it does turn bad, and I tell everybody, you gotta realize that, and some people have find it hard to believe that, maybe Amazon or Nvidia or whatever name it is that's these high flyers that, seem impervious to ever staying down. They will go down. They will go down 70, 80, 90%, and they will stay down for years and years and years and years and maybe even decades, just like Microsoft did, Qualcomm, and all the high flyers in 2000. 20 years it took to get back to even. GE, these stocks were down 90%, some even more than 90%. I mean, you take a look at NVIDIA just was down about 30% correction not long ago. And just prior to that, I don't know if I think it was last year, went
Back
from,
in
I
2022.
think it was 36 down to 10, which
Hmm.
was like, a 60% correction. That was within its bull market uptrend. Imagine when it
Right.
tops.
Yeah.
It went down 60% in the good time,
Hmm.
so imagine when it actually puts in a secular top, it'll be down. The average secular leader, once it tops, goes down 70. And it's my 50-80 rule, I call it.
Yeah.
50% go down 80%, 80% go down 50%. And they generally stay down for many cycles, and they're not leaders again. Sometimes never, and sometimes it takes minimum of 5 years and usually 10 or more.
Hmm.
But to
If
answer your
they
question,
ever come back, right?
if they ever come back,
Yeah.
um, to answer your question, like how do you deal with the risk? Well, first of all, I would look at implied volatility. And
Hmm.
so if you have a stock that trades quite a bit, trades options, and it's a bigger name, you're going to get a pretty good idea of what the potential volatility is. We have a formula that we use, and then it'll tell us pretty accurately, this is going to fluctuate 10% in either direction. This is going to fluctuate 6%, and it's a pretty good guide. And if you want to be really, super risk adverse, you could double that, especially in the names that maybe don't have as good visibility. Double that number, and that'll give you sort of your worst case scenario. It could be worse, but that generally speaking. So now I have to, decide if what position size, and if I want to accept that risk overnight. And that's usually the answer is no, unless I have a cushion, unless I have some cushion in the stock, or at least some cushion in the trading where I'm dealing with profits and I'm not underwater. I'm not going to start rolling the dice if I'm down. And the better I'm doing trading, the more aggressive I get. The worse I'm doing trading, the more conservative I get.
Right. Well, and this is maybe a good time to talk about the fact that you're a lot of times doing that selling into strength so that you can free roll the trade. Maybe explain for people that aren't familiar with that strategy what you're doing there.
I'm almost always selling into strength unless something's going wrong and stock starts coming back on me. I'll backstop sometimes and put some kind of trail behind it if I want to hold it for a bigger move. But I'm trying to get out when the getting's good and selling into strength. I want to get it. I want to sell it as the stock's going up, because if I sell into strength, then I'm always selling at the highest point of my own equity, so I don't have any drawdown. Right? If I'm selling up into the strength, there is no equity drawdown, because once I'm out of the stock comes down, fine, but my portfolio doesn't come in because I sold into strength. So I don't have much volatility. I don't have much drawdown. And that's the secret to not having drawdown, is to sell into strength and not hold through the big gyrations. Um, but and then again, like you said, um, if I have a big position and I'm going into earnings and maybe say it's up 10% and applied volatility says it's going to move 10%, well, maybe I'll sell half of it or a quarter of it, and that will give me some cushion to go into those earnings. And then if we get past that storm and maybe we buy it back, but certainly, always looking at the risk side of the equation first.
Yeah. Do you ever use options to hedge a position? Um, or is
I
that not your
don't.
thing?
I
Mhm.
don't.
Mm,
I don't.
mhm.
I don't use options. I think options for the 99% of the public are a complete sucker's bet. Some
Mhm.
people can make money. We have a couple of our own members, our own
Right.
clients that do really well, but it's very rare.
Mhm.
Yeah, I don't generally hedge either. I'm
Mhm.
not going to like hedge short one position against another. If I'm ever hedging at all, I might short the indexes against
Right.
my portfolio. Maybe I have a bunch of stocks, market's getting extended, stocks are extended. I don't want to start liquidating a bunch of names, so I'll put a short on and I'll get sort of a somewhat of a hedge by default. But usually, every position I take is has to stand on its own legs.
Right.
That has to be shortable on its own. It's not just because I'm offsetting along.
Mhm. And I wanted to get back to something that you mentioned because when you're talking about the selling into strength and how that really reduces your drawdown, I'm gonna do a quick throwback because one of the times you were on the podcast, you talked about the necessity for sacrifice. A lot of people think that they can have it both ways, right? So the other end of that, when you are reducing your drawdown, that does sometimes mean that things go up without you. How do you handle that? Because again, FOMO is real, right? A
Yeah.
lot of people really struggle with, oh, I sold into strength and it just kept going, and I wasn't in it anymore. So how
Yeah.
do you deal with that?
Well, if you're going to let the result justify the means and you're going to Monday morning quarterback and always look and say, I should have, I could have, I would have, you're going to have a very tough time being a stock trader and making money because it's not what it's about and you're not going to get the high. And that's just not what trading is about. So to me, I just want to make a lick on the stock, make more money than I risked and do it as many times as I have to get to my goal. It doesn't really, I don't care where the stock goes. It's not an exercise in ego. It's not even an exercise in trying to get the biggest winner. It's just a matter of making more on my wins than I lose on my losers. And then it's just a matter of deciding what's on the table, where's the easy money and how many times can you roll it over? So and I always say this and I think I borrowed it from Paul Tudor Jones. I can't remember at this point, but you're gonna buy stocks that go to zero and you're gonna sell stocks that go to infinity. So your job as a trader is to operate in the middle of that and to cut off that downside and take advantage of as much as you can on the upside, but you're never going to be able to trade that perfectly. But what you can do is perfectly trade your plan. So, and that's the key. I go in with a plan, I trade my plan, and my plan is a good plan. It has an edge, and I roll that edge over as many times as I can. Some people's edge, they find it in different places, or they find it in different sizes. So somebody may be a long-term investor. Their average gain is going to be much, much larger than mine and that means their average loss can be larger to a certain degree, to a certain extent, and their turnover is going to be less. Well, that's the same thing as if you've got Walmart or you've got a Ferrari dealership. Walmart does a lot more volume, a lot more turnover, but their margins are 1 to 3%, and they're doing a lot more business. Stock trading is just like any other business. It's just a matter of buying merchandise and selling it for a higher price than you paid for it and doing it as many times as you can. I mean, that's what a hamburger shop wants to do, right? I have a friend, he's got a bagel shop. He could tell you the entire bagel, what the pickle cost, that's 3 cents, this is 9 cents, this is 42 cents. The bagel costs me 89 cents. I sell it for $3 or whatever, $1.89. This is what I make. I make a dollar. He knows it. He has it nailed down. He knows exactly how much it cost and then what he's selling it for. Now, what's the goal? Sell as many bagels as you can. Turn that thing over as many times. Every time you sell, you're making a buck, right? So that's trading. I mean, that's trading. That's what people get that they get away from that focus and they start thinking about the next Amazon.